I have to admit, when I first looked at this week's stack of reports, I felt a little bit like I was losing my mind. I mean, I actually had to check the dates on some of these headlines just to make sure I hadn't, picked up a sci-fi novel by mistake.
It was a disjointed week, to say the least.
Disjointed is an understatement. I mean, just look at this spread. On one hand, you have corporate offices getting raided by police, like literally vans pulling up, seizing documents, and then the very next morning, that same company posts record profits. Then over here, the car that basically invented the modern EV market is getting canceled to make room for robots.
Yeah, it does sound pretty dystopian when you lay it all out like that.
Exactly. And then you've got gold prices that just look like a typo. It feels like noise. It feels like chaos. But you're here to tell me there's actually a logic to all this?
There is. It definitely feels chaotic if you're just scrolling through a news feed.
Yeah.
But if you stop looking at the headlines individually and you look at the capital where the actual money is moving, a very clear picture starts to emerge. We aren't just watching random news events. We are watching a synchronized great reshuffle of the global economy.
The great reshuffle. I like that. It sounds ominous, but organized.
It is organized.
Oh.
And the theme is consistent across almost every sector we looked at this week. The theme is kill the past to fund the future. And that future is incredibly expensive.
And that is exactly our mission for this deep dive. We're going to connect these dots from Silicon Valley to the high street banks and figure out what this reshuffle means for you. Because if big tech, the banks, and retailers are all making these huge moves at the same time, it's going to impact everyone's portfolio and probably their job security, too.
Precisely. We are seeing major players aggressively shedding legacy products, legacy habits, and yes, legacy roles.
Okay, so let's start with the most expensive part of this story, the CapEx wars.
This is the engine. This is what's driving the entire reshuffle.
We just got the Q4 numbers and the forward guidance for 2026. And eye-watering doesn't even begin to cover it. Let's start with Meta. They beat their estimates, great quarter, everyone's happy. But then they drop the hammer on how much they plan to spend this year.
It was a bombshell. Meta guided their capital expenditures, their CapEx, right? The money they spend on physical assets, servers, data centers, that kind of thing. They guided it to be between $115 and $135 billion for 2026.
Just to pause on that, $135 billion. In 1 year, that's bigger than the GDP of most mid-sized countries. That's more than the entire economy of Kenya or Cuba.
It is staggering.
Yeah.
And the market's immediate question was, what exactly are you buying? It's not just more storage for Instagram photos. Mark Zuckerberg was very specific on the earnings call. This is infrastructure for agentic AI.
Okay, agentic AI. We hear AI constantly. It's the buzzword of the decade. But agentic feels like a new, specific term we need to unpack. How is that different from the chatbot I use to write a polite email?
Well, it's a huge conceptual leap. Current AI is, largely passive. You ask it a question, it gives you an answer. Agentic AI has agency. It can perform multi-step tasks to achieve a goal. Think of it less like a chatbot and more like a high-level digital employee.
Okay, give me a real-world example.
So instead of asking a chatbot, what are some good hotels in Tokyo, you would tell an agent, plan a vacation to Tokyo for me next March. Here's my budget, I'm focused on food, and book the flights and hotels. The agent then goes out, negotiates, interacts with other software, and executes the transaction.
So it's not just talking, it's doing.
Exactly. It's AI-driven commerce.
Yeah.
Meta is betting $135 billion that AI is going to move from being a content creator to a commerce driver.
Okay.
They want to own the layer where all that economic activity happens.
And that explains the price tag. But it seems like Wall Street's having a bit of a panic attack about the bill coming due. Because we saw something similar with Microsoft, right?
We did.
Yeah.
Microsoft actually had a monster quarter on paper. They hit $81.3 billion in revenue. Their cloud division alone, just the cloud, hit a $51.5 billion milestone. I mean, these are huge, successful numbers.
But the stock slipped. I looked at the chart and thought, did they miss? But they didn't.
They beat the numbers, but they lost on the margins. Microsoft spent $37.5 billion in just that one quarter on AI CapEx. Investors are doing the math and realizing that operating margins, the actual percentage of profit they keep, are getting squeezed.
It's a tension, isn't it? The market yells, you must win the AI war, don't get left behind. But then it whispers, but please don't spend too much money doing it.
That's the paradox. It's like remodeling your house while you're still living in it. The investors want the shiny new kitchen, but they hate seeing the drywall dust everywhere and the bills piling up.
Speaking of remodeling, or maybe demolition is the better word,
Yeah.
we have to talk about Tesla. Because out of everything in the stack this week, this one actually made me gasp.
The end of the Model S.
The Model S and the Model X. Gone. Next quarter.
It's the end of an era.
I mean, this is the car that made EVs cool. Before the Model S, electric cars were, well, they were glorified golf carts. This is the flagship. Why kill it now?
You have to look at the factory floor. They are taking the production lines in Fremont that build these cars and converting them to build Optimus.
The humanoid robot.
Yes. Tesla recorded its first annual revenue drop down 3%. They know the EV market is getting saturated, competition is everywhere, and margins on cars are compressing. So Musk is making a burn-the-boats decision. He is swapping a known revenue stream luxury cars, for a hypothetical one, mass-produced humanoid labor.
That is just incredibly bold. I mean, I see Teslas everywhere. I have never seen a robot walking a dog or folding my laundry.
It's a massive gamble. They've outlined $20 billion in CapEx for 2026, and a huge chunk of that is for this robot infrastructure, plus expanding the robotaxi program to 7 U.S. markets. They're effectively telling the market, we are not a car company anymore, we are an autonomy company.
It fits your kill the past theme perfectly. But here's the thing about spending hundreds of billions on robots and AI brains. That money has to come from somewhere. And it feels like for the average employee, the bill is coming due.
That is the dark side of the Great Reshuffle. You cannot spend $135 billion on chips and data centers without finding efficiencies elsewhere. And in 2026, efficiency is just corporate speak for fewer humans.
And we saw Amazon announce huge cuts this week.
Right. Amazon is eliminating about 16,000 roles. Now, it's important to look at the nuance here. They're framing this as a restructuring. They're offering 90 days for internal job searches and severance, so they aren't just, kicking people out the door empty-handed. But they are cutting.
And at the same time, they are still hiring, right?
Yes, but only in strategic areas.
Which I'm guessing means if you know how to build the agentic AI, you're hired. If you manage legacy fulfillment logistics, watch out.
Precisely. It's a skills reshuffle. We saw reports from India specifically where 500 to 800 roles are affected. This is a global tightening. And it's not just tech. Look at Home Depot.
Yeah. Home Depot caught my eye because of the return to office mandate. They're cutting 800 corporate roles, which is tough, but they're also telling everyone else, you need to be in the office 5 days a week.
And did you catch the specific language they used?
Something about speed.
Increased speed and agility. They're battling softer demand for big-ticket items. People aren't renovating their kitchens as much right now because interest rates are high. So the logic at Home Depot is we need fewer people, but we need them in the same room working faster. It's a very traditional, almost old-school reaction to a modern problem.
It feels like the era of relaxed tech growth or hybrid flexibility is officially dead. It's perform or get out. And honestly, that vibe is hitting consumers too. Look at Southwest Airlines.
Ah, yes. The end of open seating.
54 years. I grew up flying Southwest, and the cattle call lineup was just, it was part of life. You stand in line, check your number, spot the exit row, and you run for it. Now, assigned seats?
It's another example of squeezing out efficiency. But in this case, it's revenue efficiency. They aren't doing it just to be nice or to reduce anxiety. They are doing it to launch fare bundles.
Bundles.
Yeah, they want to monetize that extra legroom. Under the old system, the fastest runner got the best seat. Now, the person willing to pay an extra $40 gets the best seat. They're trying to extract more revenue per passenger.
Everything is getting optimized. Even my coffee. Did you see the Starbucks numbers?
I did. A rare bit of stability in this stack of reports. Transactions rose for the first time in 2 years.
Which is huge for them. They've been struggling.
It is. Their CEO, Brian Nichols, is outlining a turnaround that focuses on menu and digital updates. It seems like their reshuffle is actually starting to work. Unlike Tesla, which is trying to invent a new future, Starbucks is just simplifying to get customers back in the door.
So let's zoom out. We've got tech companies building the matrix with agentic AI. We've got retailers calling everyone back to the office to work faster. We have airlines charging for seats that used to be free. But while all this corporate maneuvering is happening, the financial markets themselves are acting, well, a little unhinged.
Unhinged is a fair description. If you look at the macro picture, we are seeing some significant volatility.
Can we please talk about Deutsche Bank? Because the story just broke my brain.
It is a classic example of the disconnect between operations and regulation. Let's look at the timeline. Tuesday, police raid the Deutsche Bank offices in Frankfurt and Berlin. We're talking prosecutors seizing documents in a money laundering probe.
Which usually tanks a stock. I mean, police raid is not a headline you want associated with your bank.
Usually that sends investors fleeing. But the very next day, Wednesday, they report a record pre-tax profit of 9.7 billion euros for 2025. They hit all their financial targets.
It's like, sorry about the police vans out front, but hey, look at all this money we made.
And the market loved it. It illustrates that right now, investors are prioritizing cash flow above almost everything else. As long as the money machine is working, they are willing to hold their nose at the legal trouble.
But that sentiment is fragile, right? Because look at Carvana. They didn't get raided, but they got hit by a short seller report.
Gotham City Research. Now, for listeners who don't follow the short game, these are firms that bet against a company. And then they release a detailed report explaining why they think the company's failing or, lying.
And they went after Carvana hard.
They alleged Carvana overstated earnings by over $1 billion and relied on related party financing.
And the stock just dropped like a stone.
Down 14% immediately. Carvana came out swinging, calling the report intentionally misleading, but the damage was done. It just shows how on edge everyone is. Investors see a headline and they sell first, ask questions later.
Speaking of fear and selling, or maybe buying, have you seen the price of gold?
You cannot miss it. Gold topping $500 an ounce, silver nearing $120.
That is historically high. I remember when people thought 2,000 for gold was crazy. What is driving this?
It's a mix of things. We have what analysts are calling thin liquidity.
Explain that term for us.
Okay, imagine a crowded room with only one small door. Liquidity is how wide the door is, how easy it is to get in and out. Right now in the metals market, the door is narrow. There just aren't enough sellers to meet the demand, so the price jumps around wildly.
And why is the demand so high?
Speculative flows. People see the volatility in stocks like Microsoft dropping despite good earnings, and they rush to hard assets. They want something physical.
It's a flight to safety that's turning into a rocket launch. And then in the hard-to-explain category, we have crypto getting involved with biometrics.
This is the World Network story. Their tokens surged because of a report that OpenAI, which is backed by Microsoft, is exploring a biometric social network using World's ID system.
A biometric social network? That just sounds like a privacy nightmare.
Or a necessity. Think back to what we discussed at the top of the show, agentic AI. If the internet is about to be flooded with AI agents that act like humans, transact like humans, and talk like humans, how do you prove you are actually human?
You need a proof of human ID.
Exactly. World Network uses an iris scan biometrics to verify humanity. The idea is that in the future, you might need that scan just to log in to prove you aren't one of Zuckerberg's agents.
Wow. So Microsoft spends billions to create AI that mimics humans, and then OpenAI might use crypto tech to prove who is actually human. The problem creates the solution.
It's a fascinating, if slightly circular, ecosystem.
All right, let's zoom out to the people pulling the levers on the economy. The Fed. We had a rate decision this week.
We did, and for those hoping for a cut, it was a disappointment. The Fed held rates steady at 3.5 to 3.75%.
Why the pause? I thought inflation was tamed.
Not quite. The language they used was that inflation remains somewhat elevated. But more importantly, they upgraded their growth assessments.
Meaning the economy is doing well.
Yes. Remember those Deutsche Bank profits. Remember the spending at Meta. The economy is growing, so the Fed is saying, we don't need to cut rates to save the economy right now. But it's worth noting, there were two dissenters who wanted a cut. The Fed itself is divided.
And it sounds like there's some drama brewing regarding the Fed's independence, too.
This is a critical story that flew under the radar for many. Chair Powell made comments about a Supreme Court case regarding the removal of Governor Lisa Cook. He called it perhaps the most important case in the Fed's 113-year history.
That is some heavy language from a guy who usually speaks in carefully coded riddles. Why is this case so important?
It goes to the very heart of the Federal Reserve structure. The core issue is independence. If the Supreme Court rules that a president can fire a Fed governor at will, it changes the entire dynamic.
Because then the president could just fire anyone who doesn't lower interest rates when he wants them to.
Exactly. Politics loves low rates because it boosts the economy in the short term, but that often leads to inflation in the long term. Powell is signaling that if you break that independence, you break the stability of the dollar.
Speaking of the government and money, we saw a rare collaboration this week. The Trump accounts.
Yes. This is a savings initiative. The U.S. government is offering a one-time $1,000 contribution for eligible employees' children.
A seed fund for kids.
Right. But the corporate response is the interesting part. J.P. Morgan Chase and Bank of America have agreed to match that seed money.
So the banks are jumping on board immediately.
They are. Regardless of the political origins of the policy, seeing the Treasury and the biggest banks align on a mechanism like this is noteworthy. It's a public-private partnership aimed at boosting long-term savings, which is something the banks always like.
It's nice to see some alignment when everything else feels so chaotic. But there is one area where alignment seems to be breaking down, and that's the dollar itself.
The currency wars.
We've got the president signaling comfort with a softer dollar. For the listener who isn't a Forex trader, what does that actually mean?
A softer dollar means the value of the dollar goes down relative to other currencies like the euro or the yen. That makes U.S. exports cheaper. If you're a manufacturer in Ohio, you love a weak dollar because it's easier to sell your goods abroad.
But there's a catch.
Right. There's always a catch. As strategists are warning in the reports we read, a weak dollar can signal eroding confidence in the U.S. economy. It also raises the risk premia on Treasury bonds.
Risk premia. That sounds expensive.
It is. It basically means that if you devalue your currency, lenders, the people buying U.S. debt, demand a higher interest rate to compensate them for the risk. It becomes more expensive for the U.S. government to borrow money.
Which brings us right back to those massive numbers we started with. Everyone is borrowing, spending, and betting big.
Exactly.
So let's try to wrap our heads around all this. I'm listening to this. Maybe I'm driving to work in a car that's about to be discontinued, worrying about my job security. What is the takeaway?
Yeah.
The takeaway is that we are in a transition period. A very expensive, very messy transition.
The great reshuffle.
Yes. Look at the pattern. It is undeniable now. Meta and Microsoft are sacrificing short-term margins, taking a hit on their profitability today to build the AI infrastructure of tomorrow. Tesla is sacrificing its most iconic products to bet on robots. Amazon and Home Depot are sacrificing headcount and flexibility to gain speed and efficiency.
They are all just clearing the decks?
They are. They are betting that the future is high-tech, automated, and AI-driven, and they're willing to endure some serious pain and inflict some pain on their workforces to get there first.
And the market doesn't quite know how to react yet. That's why we see Deutsche Bank up, Microsoft down, and gold going to the moon. It's confusion.
It's volatility born of uncertainty. We know where we are going towards this AI future, but we don't know if the bridge we're building will hold the weight.
That leads me to a question I've been mulling over since I saw that Tesla news.
What?
Here's the provocative thought to leave you with. If Tesla is willing to kill the Model S, the car that built the company, to bet on robots, and if Meta is spending $135 billion on agentic AI, what happens if they're early?
Or what happens if they're wrong?
Exactly. These are bets that need to pay off. But if the technology takes 5 years longer than they think, or if consumers just don't want a robot butler, what happens to the economy then? These companies are burning the furniture to heat the house, assuming summer is coming. But what if winter lasts a little longer?
That is the multi-trillion-dollar question. And looking at the gold price, it seems some people are hedging their bets against exactly that scenario.
Indeed. Well, on that cheerful note, keep your eyes on the horizon, keep an eye on your portfolio, and maybe go hug your car before it gets replaced by a robot. Thanks for listening to The Deep Dive.
Take care, everyone.